Leading up to the election, many voters felt that neither candidate adequately addressed the growing U.S. fiscal deficit. With Trump now in office, this will be an obstacle that he'll likely need to face. What are your thoughts on this?
I think it's the right question to be asking here. I mean, if we stand back from all of the noise of this election and so many other elections that we've seen around the world in the last 12 months, the big risk that's emerging in markets is sovereign credit in nature. And it's very different from the last couple of cycles. You know, we had a corporate credit cycle in the late 90s, a household mortgage cycle in the mid 2000s, and now sovereign credit risk is the key risk that's emerging. And I think the challenge that faces Trump is the same challenge that would have faced Harris, ironically, and that is that the US fiscal situation is a little bit like a runaway freight train at the moment. The majority of expenditures in the fiscal budget are mandatory in nature, entitlement programs, and the minority are under upward pressure. Think of defense spending being close to a generational low right now as a percentage of GDP. Think of the challenge of the government rolling its debt to higher interest expense. And so we have a really meaningful fiscal challenge in the United States. As of the last 12 months, the deficit was 6.3% of GDP. And there are proposals that markets have been worried about to lower taxes that Trump has been talking about. But a lot of uncertainty remains as to whether that will actually occur. He may have a majority in the House, the Senate, and obviously the presidential vote. But to get a tax bill through often requires 60% of the Senate because of the filibuster rules. And so I think we just don't quite know what's going to get proposed, what's doable. But we do know the fiscal issues in the United States are runaway train. And ironically, not so different from problems we're seeing elsewhere in the world. So I just keep an eye on sovereign risk as you look forward in markets.
You mentioned a lot of uncertainty. Gold, which is often perceived as a safe haven asset, is up over 30% so far this year. So can you share how gold typically behaves around elections?
We haven't seen any clear statistical patterns between gold and election cycles. There's a lot of noise, basically. Each election has its own idiosyncratic character. What we have noticed over time, and it's perhaps not a surprise given the potential hedge nature of gold, is that gold seems to be driven much more by structural moves in monetary policy and structural geopolitical event risk. This makes sense. One of the things, though, that's worth thinking about is how could sovereign risk manifest itself, and what role could gold play in that scenario? One scenario is that bond markets get very concerned about the sovereign fiscal dynamic. And in fact, since the Fed cut interest rates by 50 basis points, we've already seen the long-dated yields move up by 80 basis points. If bond markets move high enough for long enough, that can pressure a fiscal adjustment that's recessionary in nature. Can be bad for all assets in the short term, but gold tends to benefit in recessions because interest rates move lower. The other scenario is that we do nothing and fiscal deficits persist, and in fact they get worse because governments have to roll their debt at higher interest expense. In those scenarios, we could have a more stagflationary environment, and gold was a really good potential hedge against that during the 1970s. And so there's ways in which gold can serve as a potential hedge, but it's less linked to the electoral cycle and more linked to the structural, monetary, fiscal, and geopolitical picture.
Okay, well, thank you. We'll see how things play out. Thanks, Matt.